And when we see first presented fair value gap, there's logic that has to be implemented. Just simply because it exists in the chart. Oh, there it is. It's a fair value gap. So now I know what I'm going to do, right? It's going to go up, and then they're going to say, look at this. It's going to go down. And why did it fail and went down here? Because you left smooth edges inside of what? The opening range. That first 30 minutes, it can go all over the place. You have to wait until everything is in alignment for that narrative that you're expecting to be there. Now, let's roll this back for a second to what I was saying about this fair value gap here and how this fair value gap, if it went above it, would run for that liquidity. Let's say we did this. And I think I earned the right to be able to talk hypothetically at this, right? We have these relative equal lows. Let's say that as soon as the first presented fair value gap formed, let's say that this low had taken that low out there. If it would have done that, in other words, this low went lower than that one, as soon as this shift in market structure there occurred, once that occurred, any retracement back down in that first presented fair value gap would be a viable long. But you can't take that as a long if these relative equal lows are there and we're in the first 30 minutes of trading, because the opening range is not 15 minutes. Everybody ran the orb. I'm an orb trader. Orbs, baby. ORB. Orbs breakout trader. Oh, man. 30 minutes, folks. Okay? 30 minutes. That's what the algorithms do. That's what all of the large institutions factor, that 30 minutes. Okay? I know you don't believe me, but compare it. Look at your Mickey Mouse 15 minutes, okay? And then look at the full 30 minutes. I've even got into the first hours of trading. The first 60-minute trading is going to, again, give you much more information, and you're going to find a whole lot more clarity and continuity in your setups and your short-term to swing trades using that. We're going to segue into that in March. So, but you have to know the mechanics of how to use the opening range and also the first presented fair value gap. So we talked about narrative. We talked about the effects of the weekly profile. They left these relative equal lows here. If this would have done something like this, where if it would have ran up, didn't come back down like this. So in other words, say it created this low, it ran up, created the first presented fair value gap here, and just kept on going and took that liquidity out there. What would I have done differently? And what would I have done to trade it? I would have waited for the price to come back down into this gap, and then I would have treated this as inversion fair value gap. So in other words, I was expecting it, or would be expecting it rather, the market could trade down below it and then come back up and hit midpoint or fail to get in there. I'd be scaling in shorts here and take first partial here and let runners reach for lower prices. Why? Because it took this initially right away, but it didn't do that. It left this here, created the first presented fair value gap, dove down, knocked out anyone that wants to go long. And why would the market go up there? Why would it want to go to this liquidity? I told you before 9 o'clock, it was likely to use this to go up to there. Why is this viable? You see this little pink line with the number next to it right there? What do you think that is? I'm going to maximize this chart because I don't want you looking over here at these things. Not because there's something over here I'm trying to hide, but I want your full attention on this time frame. Pay attention, young Padawan. Here is regular trading hour settlement price for Thursday at 4:14 p.m. If we go to regular trading hours, that's this right here. Okay, so you have 4:14 p.m. Eastern time. Make sure your charts are always toggled to New York local time. And then we were opening up down here. At before 9 o'clock rather, we were down in here. And I pulled up that range that you can't see because there's no electronic data showing. It's only going to show you the closing price on regular trading hours at 4:14 p.m. Eastern time. And then it'll start populating the regular trading hours at the 9:30 a.m. time. So the open on this candlestick is here, right there. And let me show you. I'll toggle. And here's a screenshot. You can take a screenshot of that and you'll get the levels for the Fibonacci in case you guys are talking. Can you please show me your Fib settings? There it is. I heard you. chapstick. So there's the open to the close. So we were down here before 9 o'clock while we were doing the live stream yesterday. And I was just simply running some numbers, looking at it, just visually looking at it. I'm at my dining room table, sitting here. I'm not up in my office where I have all my hardware in front of me, all my computers. Well, screens. I only have one computer. But the perspective is just simply over a laptop. And I was doing it with the live stream yesterday. And based on where we were trading at around that time, I said, okay, well, I know this price was on my chart and it's up here. So around the 50% mark, which would be mid gap, consequent encroachment, that's that level right there. Okay, watch. I'll highlight that with purple, and I'll darken it up. Okay, you see it right here? Now I'll change it green. See it? That's consequent encroachment, or midpoint of the range between where we opened at 9:30 and the closing price at 4:14 p.m. Eastern Time. 4:14 p.m., that's the last tick you're going to see when regular trading hours stops.